And hello, everyone. Welcome to a very special event today, the Options Kickstarter webinar, something that has been a long time in the making. And we are super excited to finally present to you what we have in store for you today. Let me start by asking you guys a question. And this is probably more for the guys who are just starting out. Have you ever been overwhelmed with the complexity of options trading? You need some help to get started. Think about that. Or are you currently looking perhaps for some short-term opportunities with potentially big payouts? Does this sound intriguing? Or are you perhaps interested in short-term income generation? All right, it's a bit different from the previous question. Or are you looking for affordable long-term opportunities that could result in a home run payday? If the answer to any of these questions is yes, then you are in the right place. And this webinar will be the right one for you. All right, guys, so please be comfortably seated. And a quick reminder that this session, this webinar, will of course be recorded. So should you need to drop off, no problem. The recording will be sent to you once it's rendered shortly after the webinar. All right. And having this said, if you guys have any questions, don't be shy at all. This webinar is for you. Please put it into the Q&A box of your Zoom window. The more, the merrier. And Nicholas, Homer, and all our staff will look out for your questions, and we're going to attend to these as we see fit. So please don't be shy. And there will also be a dedicated Q&A section towards the end of the webinar. All right. And of course, I need to remind you that trading options, but really any asset class, does contain substantial risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is capital that you actually can afford to lose. When it comes to backtest or hypothetical performance, keep in mind that this is not necessarily indicative of future performance, and any trades and trade ideas shared in this webinar are for informational purposes only and should not be construed as trade advice. All right, so with that out of the way, let's get started. I'm going to start off by introducing ourselves, as we should. So we are tradingindicators.com, and my name is Daniel. So I'm the guy here on the left-hand side, and I will be your moderator throughout the session today. I am joined today, however, with also my business partner, Homer. Homer is my business partner at tradingindicators.com. I've been working together with Homer for the last 20 years, if you believe it. We met in grad school back in the day, and ever since we've been embarking on very exciting projects as a tag team together, which has been awesome to us. We also have Nicholas here with us today. And if you have joined us previously from previous webinars, you probably know Nicholas as the guy behind most of the innovative indicators that we create at tradingindicators.com. So he's been the mastermind behind many of these indicators. And just a few more words about us before we talk about the option professor. Most of what we do is based or rooted in technical analysis. And we believe by doing a pattern analysis of your price chart, you can, to some degree, forecast what may happen in the future. We also look at fundamental data, but mainly to potentially stay away from the market. Because if big earnings reports are coming out and you're in a trade right now, maybe that's not the best way to engage in a short-term play. We also believe that trading should be simple, but you need to know what to look for. And most importantly, we believe in teamwork, not just among ourselves, but also with our very rich and interactive trading community. And in fact, most of the indicators that we have built over the years, they have been inspired by the feedback received by our trading community. So thank you so much for this feedback, and please keep it coming. All right. Now, we also have, and I'm super excited about this, a very special guest with us today. So please, guys, meet Jim, also known as the Options Professor. And Jim should already be online. Hey, Jim, are you there?
Yes, I am, Daniel. How are you?
Hi, Jim. Nice to have you. Jim, if you don't mind, can you please briefly introduce yourself?
Sure. I'm Jim, the Option Professor, and I've been educating people both in the United States and the world for decades. So I'm very experienced in the option area. My background in college, obviously Boston College there, executive management at UCLA. But the main thing is I went to the advanced options training program at the CBOE, and I worked for very, very large firms. So obviously I've been trained and in this thing for a very long time. So I take all that experience, all that knowledge, I turn a rather complex subject matter, and I turned it into a very digestible, understandable presentation. And I work with people trying to have them get more educated and obviously increase their skills on options. And that's what I'm going to be doing with the Options Alert.
Perfect. Thanks, Jim. Awesome. So yeah, thanks for the little background introduction. And of course, Jim will be do a lot of the talking today. So, but let me just quickly move on a little bit further before Jim comes back on, because what you can expect today is something that Jim has been using in his options career, which has been quite long already. And he's been trading options for decades, and he's going to share some of his key ideas or key things that he has seen work over and over again. And of course, we are in the trading business, so these strategies are designed to make money, and Jim has seen them work. Of course, there are no guarantees in life, so there are no guarantees in trading, but this is something that Jim has seen over the years to work, and he's going to share this knowledge with us today. All right. And one more thing before we get very practical, we are going to do something what is called learning by example today. So we're going to base ourselves primarily by looking at charts. We're going to look at price charts, then we're going to think together, what are the options play at hand potentially for that price chart? So that's, instead of doing the theory first, we're actually going to look at charts first, and then we're going to think about what may happen there and what could be the options play that might be applicable. Sounds good? All right, guys, let's get started. So the first thing we're going to look at, and this is really part one of this presentation today, are short-term strangles. Now, a strangle is a particular option strategy. And I'm going to, I said I'm not going to do much theory, but I think one slide is okay. So a strangle is a non-directional play. And one of the cool things of options is that, with stocks, if you buy stocks outright, you need to be right on the direction. So if you buy a stock, the stock better go up. Or if you short sell a stock, the stock better go down. Well, with options, this doesn't have to be necessarily the case. If you use the right strategy, for example, a strangle, you can benefit from the stock moving in any direction, whether it goes up or down. As long as it moves significantly, you can profit from this strategy. And the way this is done, we're going to look at some very concrete examples in just a bit, is to buy a call option and a put option together at different strike prices. So the call option is going to be out of the money, so it's going to be above current price, and the put option is also going to be out of the money, meaning below current price. The expiration date for both is the same. Now, if you do such an options strategy, you will benefit if the stock either moves significantly up or down. And your risk is very limited because all you can lose on this play is the total premiums paid. The reward, on the other hand, of course, is potentially unlimited, but from a realistic point of view, it can be quite significant if that stock moves. Okay. All right, guys. So this was the theory part for part one. Now let's look at some charts together. And the first chart I'm going to bring up is a chart of Halliburton Company. You can see it here. And so we're going to look at HAL first, Halliburton Company. And if you look at the screenshot here, and we're going to look at the live chart in just a bit, you can see that Halliburton has been trading quite, nicely in between resistance up here and support down here, almost to the T. Here, the stock approached resistance, it bounced off. Then it approached support, it bounced off. Near resistance again, it bounced off. And now we are in a scenario the Halliburton, once again, is at a support level. And if history repeats itself, from a technical point of view, it is not unlikely that Halliburton will bounce off from this level again. But there's one caveat as well. And Jim, correct me if I'm wrong. I believe Halliburton has an earnings report coming out in the next couple of days, maybe in a week. And as you know, with earnings,
on 7/19.
yeah, on July 19th, so in about a week, the earnings report is coming out. And as you know, with earnings, these are sometimes unpredictable. You never know what is going to be reported. And this may, in addition, shake the stock price. It may drive it up, but it also may drive it down. Now think about it. The stock may go up or it may go down, but it is likely that it will move. So the options play here that might be the right one is a strangle, which is, as I said before, an undirectional play where the stock, if the stock goes up, we're going to benefit. And if the stock goes down, we will benefit. The only time where this will not work out if the stock stays put where it is, it doesn't move. So that's the only time, of course, there's always a downside of everything. That's the downside of a strangle. If the stock, the underlying, does not move, well, then we're not going to make this trade into a winner. All right. So with this said, I'm going to switch over to our live chart. I'm going to bring up Halliburton. And Jim, please, maybe you can expand a little bit on what I just said about Halliburton. What do you see when you look at this chart? I'm going to remove these indicators.
I think you're making a good point that it might rise. I have a couple of other indicators that I use in addition to this. Would it be worthwhile to show them right now, or do you want me to wait on that?
Go for it. Yes, go for it.
So
Yeah,
let's
please
go
share your
to
screen.
and let me show you a couple things that actually confirm what your analysis is also saying, because we all know that there's different ways of analyzing. Do you have the chart up?
Let's see. Yes, we can see it.
Okay,
Perfect.
good. So I look at things on all different time frames. And basically, of course, when I'm doing short-term options, I have to look at the short term. But right now on the 1-year graph, I see a low here with an RSI of 33. And then I see another low with the RSI of 37 and 43. So that's a bit of a divergence, which is telling, and you can see from the line down here, the RSI is higher than it was, even though it's low. So it tells me that the selling is drying up. I also look at the price of energy. Oil prices are having a pretty good time in the 80s. And if they were to go into the 90s, that would be very helpful, I would imagine, to Halliburton, which is an energy stock. So from that standpoint, it looks like a good idea. Here on my longer term graph, there's nothing underneath here. So that's why you'd want to do the strangle, because if things turn bad, and let's face it, these lines are pointing down on the longer term graph. If the bottom fell out, the gold line comes down here at 27 or 28. So the trap door is pretty good if it was to accelerate to the downside for whatever reason. And on the really long-term graph, you can see it's right on the edge. So this is a very critical point for Halliburton on a number of levels. And so the likelihood it's going to stay the same, in my view, is very low. And the option premiums, and they've got an earnings coming out, and the option premiums were more than reasonable. So that makes it a good risk reward and a time to take your shot. Because what I try to do is I try to get in front of news events and news, because that's when volatility can pick up. Case in point, today, Delta announced their earnings and the stock got hit pretty hard. So the bottom line is I'm trying to use the earnings reports coming out as a stimulative to the option prices. And so combination of this thing looks like it's on a support zone. The RSI is indicating the selling's dried up. Energy prices are rising. We've got a earnings report next week. The strangle makes an awful lot of sense to me at this point in time. I can unshare now.
Thanks. No, keep the chart, Jim. Please, we had one more stock that we discussed before. And what about Alcoa? I believe Alcoa also has an earnings report coming up.
Yep, it does. And if you look at Alcoa on a long-term basis, we can see that it is right down here at 38, smack in the middle. It's really trying to get above the blue and the gold line I've got. It's really right at the 50 number, so it's decision time. If this thing goes in the RSI and starts breaking under 50, then it could come easily back down to the red line or even take it out. However, if we get a nice earnings report and it starts busting above 45, there's a whole lot of room up here for this thing to go and keep going. On the 5-year graph, you can see again, it's right in the, I call this the congestion area. I call this the traffic jam. And a traffic jam at some point loosens up. We've all been in a traffic jam. But when you got all the averages meeting at one point, it's like all the cars in one level in one intersection. And you don't stay in that intersection forever. Somebody says, you go ahead. No, you go ahead. So at some point, either the bulls are going to get the green light and this thing is going to take off into all this white area, which is possible because this is an industrial metal and infrastructure has a very bright future. Whether Trump or Biden gets in or Biden substitute gets in. So again, the future for spending in this area is pretty good. Now, again, it's at a critical point. So dropping down to a lower price is not out of the question. Again, all the moving averages when they're under purple means the bears are controlling the narrative. When all the averages are above the purple line, the bulls are controlling the narrative. That's why I'd have the insurance put, because the insurance put's going to bail me out in case we wake up and find out they're talking recession and all bets are off as far as infrastructure. On a shorter term basis here, again, you can see it tried to rally, and so now it's underneath all this stuff. So this is tailor-made for a strangle because the premiums are very reasonable. And this thing has shown you just since the beginning of the year that it can go in very volatile times. I mean, very volatile situation. Again, this thing with the right earnings report could pop up here and start taking out 44 and 46. With the wrong one, it's already got some weakness here, so it could give it up and go all the way down towards here. So volatility going into earnings with this particular company in this particular sector, which is metals, infrastructure, industrial metals, I don't think is a very far-fetched idea. And again, the risk on these things are always limited. So you don't have to be right on every single trade to come out on top. So that's why we try to keep the risk on the straddles at a very reasonable price so that we can afford to diversify, and that if we're wrong on a few, as long as we catch a few good trains getting out of town, then we should be net okay. That's the idea.
Awesome. Thanks, Jim. And let me quickly grab the screen back because I'd like to expand on this just a little bit of what Jim said. So here I have Alcoa brought up on our dashboard, the Liquidity View dashboard. And one thing I can see here straight on the scanner here, if you go all the way to the right column, you can see that volatility is not high. It's not extreme, it's not high, it's medium, meaning typically that option prices up tend to be a bit lower because, you know, they are driven up if volatility increases. The more volatile an underlying symbol is, the higher the option prices. So one additional reason why prices are reasonable right now for buying into this strangle idea. And one more thing, if you look at the price chart, if I expand this a little bit, we can also see that this stock is somewhat in the middle between support and resistance, meaning there's room. This stock can move. We're at 38 right now, around 38. This stock can easily go up to resistance up here at 45, or perhaps even all the way down to 24. This stock can move, therefore a strangle seems to be, as Jim said, a reasonable idea in this case. All right, so one more example on this topic. We also have a General Motors. Now, General Motors is a bit similar to what I just said. So if I open this one up, and Jim, please expand on this if you want. So let me put on a GM here, General Motors, if I can find it. General Motors.
And we're already getting action on the straddle today with General Motors up 2.5% already today. So awesome. I'm not the only guy. I'm not the only guy who can see these things sometimes. So you got to move, and you got to move, right?
And one more thing here, what I see right off the bat, just by looking at the way we typically look at charts here, trading indicators, is we can see that this stock also is right smack down the middle, in between this support zone around 42 and this resistance zone around 50, 49.50. So there's a lot of room in both ways once again. And yeah, that stock has room to move. It's likely to move. As you can see here, it's been bouncing off these levels quite vividly in the past. So, you know, if the past is any indication of what may happen in the future, well, there's room to move. Yeah. Jim, would you like to expand a little bit?
Yeah, can I show a little bit about GM? Yeah. Okay, can you see my chart?
One second, starting. Yeah, you got it.
Okay. So
Go.
anyway, as far as General Motors is concerned, I'm looking at it on a 20-year basis. You can see that it went from 65 down to 30, and that's all done now. And now the red line's pointing up, and we're above everything. So there's a lot of upside potential. I also this notice I'm diversifying from sector to sector a little bit, so we don't have it all in one thing. With regard to the automotive sector, you saw what happened to Tesla recently, and so that means to me that that sector seems to be having a bid right now. And this stock here on a longer term basis definitely looks like it's uptrending. If I go to the 5-year graph, I can see it is uptrending and it's holding the red line very lovely on the way up. So, breaking above 50 is not out of the question on a good earnings report. And then, of course, if it breaks the red line, which comes in around 46 bucks, obviously there's a little room on the downside for it to break. So you've got a break potential if it gets weak, and you've got an acceleration potential because that RSI has been above 50 for a while, but it's not into the 70s. It's only into right now the 60s. So sometimes you'll have an acceleration phase, which takes it into the 70s. If that's going to happen, we'll be seeing this above 50 for sure. Now, on a 1-year graph, you're also looking here at a bit of a breakout. It held the blue line pretty nicely here. That RSI looks like it's definitely turning up. It's only at 58.60. And this is a key point. If it can not get through the 60 number, and right now it's at what, 58? If it can't get through the 60s, then it can't get to the 70s or 80s, so you're not going to get the acceleration phase, and it could go the other way. But right now, it looks like it's trying to go into an acceleration phase, and a decent earnings report could get people interested in this as well. So again, when it's right there on the line of 46, and you take a little bit out of the money, a little bit out of the money on the call and puts, and you don't pay very much, and you got an earnings report, and you're good for the week of earnings and the week after earnings. I mean, your expiration date. You want to be in there for the week of earnings and the after week, because either it's going to possibly have volatility going into earnings, or if that earnings report is not exactly what people are looking for, people will change their opinions like they did on Delta this morning. So that's why this thing looks like a very good opportunity, and that's why it's interesting to me.
Awesome. Thanks, Jim. I'm going to share back my screen real quick. And just give me 1 second. There we go. I believe Doug pointed out that the people could not see my screen previously. So here's just a quick repeat of what I said, is that this stock, as mentioned previously, is right smack down the middle between support and resistance, as you can see here. So this is on our Liquidity View dashboard. And once again, this stock has room to move. And with an earnings report coming out, it is not unlikely that this stock will indeed move. All right. So, all right. So let's recap real quick of what we just discussed. If I can find my slides back. There we go. Okay, perfect. So now we've talked a lot about strangles and some ideas, but let's be really concrete of what the options play will be. Now, we've looked at Halliburton, Alcoa, and GM. Now, what you can see in this table here is what you can expect from our brand new service that is just about to start or has started for some of our members already. Because we are going to make it very concrete for you. Powered by Jim's Insight, the Option Professor's Insight, we're going to tell you some of his stocks that he is considering for strangle entries. And for every idea that he has, you can see exactly what is the expiration date for that trade. If you remember, for a strangle, the expiration date for both the call purchase and the put purchase are the same. So in this case, July 26 for Halliburton. We're also going to tell you what are the strike prices, and they're always going to be out of the money strike prices, at which the call should be purchased and at which the put should be purchased. An indication of the average cost for these for purchasing these premiums is also indicated. You can see it here, $1, since each option contract always relates to 100 shares. The total cost would be only $100 per contract on each side. Or the combined, it's the combined one.
Strangle is only 100 there, yeah.
The combined strangle, exactly. And a little note of why this options play makes sense. What was Jim's rationale of why he thinks this could be a good idea? This could be, for example, hey, this stock is just going into earnings. As you can see here. Or this stock has a lot of room to move. Whatever his reason, which could be a technical reason or a fundamental reason, Jim will also indicate here. So we're going to make this very concrete for you. All right. So this is part
Can I
one
just say one
of
thing? Can I say one
go.
thing real quick, Daniel? On
Yes.
the General
Mm-hmm.
Motors, you'll notice it's only a 1 week option. And so I'm looking for General Motors this week to make a move. And so I wanted to keep my strike prices very tight. So I went with the 47 call and the 46.50 put. Now the General Motors is at 47.64. So I'm already in the money, meaning the price of the stock is above my call. And that call has jumped up about 300% today. So if General Motors can go to 50 this week coming up, I'll get the intrinsic value of 47 to 50, which is 300, which would mean my original risk of 100 has gone to 300. So in this particular General Motors, I went with a very aggressive position because many of the traders out there, they do short-term options. And of course, I thought that the General Motors one, we could take a more aggressive view, and knock on wood, so far it looks like that was the right choice because we're getting movement right now. The other ones are more my philosophy of you want to be having an option going into the week of earnings and the week after. So the Halliburton comes out on the July 19th or something. We're in for the week of that, and we're also the next week. So we're prepared to get some volatility going into the report and after the report. The General Motors one, I just wanted to take a little more aggressive risk. It's not illegal. And so I did that one with just a week to go. And sometimes you guess correctly. And thankfully, so far, it looks like I might be onto something.
Awesome. Thanks, Jim. Yeah, great explanation. Perfect. All right. So let's move on. This was just part one, but we have more in store for you. So part two is going to be how can we use options to generate immediate income? Now, so we've looked at buying option. We're going to switch the table now, or the table will turn now, and we're going to look at selling options. In particular, we're going to sell put contracts, also known as writing puts, selling put contracts. And if we do so, this is a bullish play. So our thesis is that the underlying symbol is going to go up. So overall, it's a bullish play. And the idea is that we, as part of our, anticipation that this underlying symbol is going to go up, we are going to buy the price buy the stock at a certain price below current value, below market value. And if the stock stays above that price, we are going to collect a premium. Of course, if it goes below, then we may be forced to buy the stock at that price. But as long as it stays above, and this is a bullish play, if we are right with our prediction, we will collect a premium for agreeing to the obligation to buy the underlying at a certain price. Now let's make this very concrete. Let's look at one particular example. Let's say Dell. Hypothetically, Dell. Everybody knows Dell stock, but let's say hypothetically Dell is trading at a price right now of around $100. We are, however, confident that this stock is going to continue to go up, and certainly it will not go below 90. So this is our prediction, because every option play needs to have some sort of prediction what's going to happen in the future. So, and we want to generate immediate income based on this premise that Dell will go up and certainly not go below 90. So what we can do is to sell, not buy, sell a put contract, or write a put contract at a strike price of 90. And as a result of this, we will receive immediate income of $2 per share per contract. I'd say this is the price of that contract. As every contract stands for 100 shares, this will net us immediately $200. Now, a couple of things can happen. Okay, we sign this contract. Now, if Dell does not fall below 90, this is what we're looking for, we will keep the $200 premium. Awesome. We can do it again afterwards if you believe that Dell is continued to go up. If Dell falls, let's say 89, and the options exercise, well, then we get to buy Dell at, because essentially our obligation is to supply Dell to purchase Dell stock at a price of 90, but we still collect the premium. So essentially, we are purchasing Dell stock if the market price goes to 89 at an effective price of $88. So below current value. And of course, if should fall all the way to 86, well, then this is a losing scenario for us. Of course, every trade idea does have a losing case. And we are obliged to buy Dell stock at $88 a share, even though market value is at 86. And why 88? Because the strike price was 90, but we did collect our $200 per contract premium, which can offset the price. All right, so with this, with the theory out of the way, let's be very concrete. We're going to look at charts right away again. The first chart we're going to look at is McDonald's Corporation. And let me quickly switch over to our dashboard first, because for McDonald's, I do see, and Jim, please chime in. So for McDonald's, I do see that it is, as soon as this loads up, trading right now. And you can see this very clearly here at this support level. Okay, so this is a very important technical level. Why? Well, it's support. And support means that this stock may have, or hopefully has a hard time breaking through this level. Okay, so this stock may not go through this level. It has respected this level very nicely in the past. So chances are, and our prediction is that this stock will instead bounce off this level and not break it. Okay, so this is a bullish outlook on McDonald's, that this is an important level. It will bounce off to the bullish side. So what we can do with put writings, we could sell a put contract below current price, collect the premium, and if McDonald's indeed will not go below this level, we get to keep the premium. All right, Jim, anything to add for this idea of
can I show my chart? So I like the way my analysis and your analysis meet very nicely. So people obviously get 2 bites at the apple here. Okay, on my 5-year graph here, you see the gold line here.
Jim, you have to reshare.
Okay,
please.
no problem.
Yeah,
very doable.
No problem.
And boom, 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 we're all done.
Okay, coming up. All right, we can see it.
Now, okay, first of all, 2 things. You see the low right here? The RSI was 26, right? And now we have the same low here, and the RSI is 38. That's a huge divergence. It tells me very clearly the selling is dried out. That is combining with hitting the gold line, which you notice it doesn't hit very often. In fact, the only other time it hit it was during the COVID crash. So it's a very important line, and basis the RSI, it's clearly telling me that the selling may have dried out. Not to mention, we're talking about one of the big companies in the world. So that is the reason I thought that selling the puts here, I believe, are we going to show the actual thing or the actual trade?
For it, Jim, yeah, show the actual options chain.
Yeah. I believe, well, I'm just saying, yesterday I put together a 230 put.
That one we're going to show in just a bit.
Okay,
we're going to recap this at the end.
Yeah. Well, then basically, like I say, you'll see that is why I took the shot at it. And basically, that is why I think the setup is quite good. And the worst case scenario will show you the price you would get McDonald's at is quite a bit underneath current value, which on a company like this might not be such a bad thing. So, yeah, I just wanted to give you an idea how my analysis and the trading indicators analysis are a lot of times in concert. And when they are in concert, hopefully good things will happen.
Yeah, and Jim, if I just may add a little bit to it. So what we can see here clearly on this particular chart that you have opened, John, is that, Jim, is that this stock is in an uptrend. It doesn't require a PhD in stock analysis that this stock is going up.
Yeah.
And what we see right now is the best friend of a trend trader. We see a pullback, which is awesome, which allows, this is when you want to get into a trend trade and a pullback, not when it's overextended. You want to wait for this pullback. And that's exactly what we're seeing here. So our outlook is bullish. And our idea here is that, hey, we're going to do a put writing. You're going to get immediate income should a McDonald's stock not go below our strike price of 230. But if it does, we get to buy McDonald's at a price below 230, which is because we get to collect the premium, which will actually get us into this trend trade at a better price than what we would be able to do it if we trade this this trade outright on the stock market. All right, great. Okay, so I have one more example prepared for you. And actually, Jim, if you could just bring it up on your chart right away. And this was the example of, give me just 1 second, which one was it? It was Home Depot. What do you see on Home Depot?
Well, Home Depot, again, is right in there with McDonald's as one of the big companies in the world and certainly a stalwart of the United States, that's for sure. Basically, on the 20-year graph here, can you see it came down to all this stuff? When you're selling puts, you're agreeing to buy the stock. You want to agree to buy the stock at a good price, and you'd like to get a reasonable premium. So that's why we don't sell puts up at 420, because if it goes back down to 260, you're going to get put stock and you're going to lose a lot of money. So where would you want to agree to buy the stock? Against something that looks like support. And when it's come down from 400 to 320, people will pay you on the puts. So you get good cash and you're getting a good price. And that's when you can sign me up. You're not going to sign me up at 420 because if it goes to 450, you'll be right. But the risk of it pulling back, reverting to the mean, is too much risk for me to get involved in. So I like to get things that are good companies after corrections. And basically, that's what happened with Home Depot. It came down here to 320. And then, of course, ever since I've been talking about selling the puts, you can see the activity is up to the upside. On the 5-year graph, you can also see it's back in that traffic jam thing. It's above the purple line, so it still looks like a reasonable thing. And on a 1-year graph, I think it's probably turned up by now. And there you go. It's trying to break out on the upside a little bit. So bottom line, it's a good company. It's a big company. It's got a long history of making money. And if you want to do anything with home improvement, it is the go-to spot. So agreeing to buy Home Depot or McDonald's is certainly not a frightening experience because, again, they are very well-known profit-producing type companies.
Awesome. Thanks, Jim. Perfect. All right, so I'm going to grab back my screen real quick, and please confirm that you can actually see it this time. And right, so let's be concrete once again. So we've looked at the charts, but of course, we would like to formulate a particular very concrete options trade around that. In this case, it's all about put writing, generating immediate income. So what you can expect from our brand new service is a breakdown like this. You, of course, see the underlying here like McDonald's or Home Depot. You see what is the approximate stock price right now with the strategy at hand. The strike price, of course, at which you would like to sell the put. And then, of course, the expiration date, and of course, the strike price. We also indicate what is the approximate income that you can expect if things stay approximately the same way they are from selling this put contract. And please notice this is now income. It's not an expense because we're not buying a contract. We are selling one, and we are generating or receiving income as soon as we sell it. And we're gonna keep this premium as long as the stock will stay above our strike price. Of course, you can also see why Jim and I believe this is a good idea for selling a put contract. Jim, anything to add to this breakdown?
There's a rotation a little bit going on out of the high flying tech into the more lower PE, shall we say, value more companies. And the ones we just mentioned are that. But I did want to show you that even on high flying stocks, you can do the same type of strategy. Can you show my screen again? And I'm going to show you a couple of examples.
Yeah, please share your screen. You have to reshare it, Jim.
After decades of experience, markets will revert to the mean at some point. It's almost, well, I think it's for sure. So I can't see the screen.
Please share your screen. Yeah, please share your screen
again. I'm sorry. I'll get used to this. Okay. Did I share it properly? I don't think so.
It's coming. Yeah, we can see your desktop now.
Oh, you can. Oh, just the desktop. Okay, here we go. And then we go there. Should be better.
There we go. We can see it. Yep.
All right. So, I'm showing some pretty conservative companies, McDonald's and the other guy. You can do it on, look, here's AMD. Why don't I sell puts when it's way up here? Because I know there's going to be a reversion to the mean. Okay. And at some point, that'll give me the opportunity. You want to do the right strategy at the right time. So when this thing gets tanking down here, and I can see it's holding the gold, and then it gets back above red, and red starts turning up, that would make me want to sell the 140 puts, you know what I mean? And grab some cash. And then if it keeps going up, maybe I can sell some 150s. And I'm agreeing to buy the stock down here while the stock is going that way. So that's an example. Another example recently would have been Apple. In fact, Apple was a very good example because that was one of my great success stories recently on the call side. But here's even on the selling of the put side. You've got a situation on Apple where it came way down here from 200 bucks. Now you're not going to sell puts when it's like this, but once that baby turned up at 165 and once it got to 180, selling puts underneath the market was a cash register. Cash register. Now it's way the heck up here. I wouldn't sell puts at all. Why? Because it's extended and it's going to possibly revert back to the mean. But I don't want to agree to buy stocks at 230. I want to agree to buy stocks at 170, 175, 180, 190. I want to collect those premiums on the way up. So this is a classic example of a tech stock and a big mega cap where you could have done that. And I'll give you one of the better ones of all time in the last year was Meta. And in Meta, that baby, let me just get that up here real quick. Meta had a huge drop down there towards, well, it was down, I guess if you go a little bit further, well, you just had one there, but the bigger one is on the longer term graph where it went all the way down here to 100 bucks. And that was only what, 18 months ago. So for 18 months, you've been able to sell puts underneath Meta the whole way up. And this is cash register, cash register, cash register. And what's the worst case scenario that's going to happen is they're going to put stock to you and you own Meta. But you're going to own it under the market at a discount and you've gotten cash. And like I say, if you can follow the trend up and just keep writing the puts, you've been home free all the time. Would I do it up here? No. And you know why? It's too far up. And we just had the RSI go into the 70s and 80s, right? 80s. And now we're at a new high and the RSI is at 60. That tells me this thing's running out of steam. If you look at the price at 19, I'm not in a party of one. Some people think it's lost its steam at 550. I mean, it's gone from 550 to 515 before you can spell META. So these are some of the reasons I try to avoid. See, avoiding problems is also a big part of investing as well. So we're looking for the setups, the probabilities, the risk rewards that favor us, and that's when we hit the button.
Awesome. Thanks, Jim. Very nice insights. I'm going to grab the screen back one more time because we have one more topic to cover. And give me 1 second. All right, there we go. Okay, so part 3 of today's webinar. We're going to look at another options play here, our long-term calls and puts, which we can get for a very reasonable price, but which may be in for a home run, financial home run. Okay, so what are these all about? Well, these are all about, making a long-term or predicting a long-term directional play. All right. So one example of this, if you go to the charts right away, and it would be Occidental Petroleum. I believe you have all seen oil prices rising up. It's consolidating right now a little bit, but it is not unheard of that should oil break its resistance level around, I think, 184, 85, it may fly up all the way to 100. And what do you think may happen to a company like Occidental Petroleum, which is an oil-based company? Well, chances are the stock price of Oxy may follow suit, follow the price of oil. So if you have that foresight, you could imagine buying call options, outright call options for Occidental Petroleum in the expectation that prices will go up. But these are long-term plays, and our expiration date will be further out. Keep this in mind. Another example, and I'll get Jim talked about this in a second, would be IBB, the biotech ETF. Also this one, it's been trending upwards. It is now at a critical juncture. You can see it here. Price bounced off this resistance level many times in the past. It just broke it. Once again, you can see it. It's just above this resistance level. If we break completely free above this level, it is not unthinkable the price will just going to take off from now on because there's blue skies ahead. If you have this forecast in your mind, well, once again, a long-term outright call play with options might be the right option strategy to go. Because you can buy it fairly cheap, of course, with a far out of the money call price, or at least out of the money. And if things work out, well, this is going to earn you a potential financial home run. And one more example, metals and mining ETF, XME. As you can see down here, this thing has been trending upwards for a long time. We just had a bit of a pullback, but things seem to resume right now. And it is not unthinkable if you're making higher highs and higher lows along the way here, that this thing will take out the all-time high at 66 or 65 and then just fly off. Once again, it's a long-term directional play, and we can make this happen with an outright call option with an expiration far into the future. And of course, this doesn't always have to be a bullish play. Eventually the markets will turn bearish, or some markets will turn bearish. And the same thing, if you have this foresight, could be done, of course, with outright put options as well. All right, Jim, would you like to take over one more time and explain a little bit more about these symbols, which I just mentioned?
Yeah, can we start out with the Occidental Petroleum?
Yeah, please share your screen again.
Okay, yeah, yeah. Sorry, there we go. And here you go. And then we are all set. Okay, great. Because this is a subject I'm very interested in, because, that's one of the good things about using options. I mean, if you can find something that's going to make a major move up and you go buy 6 months of time a little bit higher than where the prices are, and it really goes, there's a significant amount of money to be made there. Just think of all these tech stocks. Had you bought just a little bit out of the money 6 months out, leave it alone, you could have made a very, very large hit. Those things have already gone through the roof. The premiums are very, very, very large. So I don't like to set up on that at all. So what I do like to set up on is things that are going to happen, not things that have happened. So the bottom line is, here's your crude oil going back 20 years. To me, this thing is obviously it's above the purple line and the gold. So the bulls are in control. Right now, you're in a little congestion here. Look at all that. Remember the traffic jam, all those 4 cars in the intersection? Somebody's going to sell, they're not going to stay in that intersection forever, right? So if we can break above these numbers of 80, no, let's call it 85, 90, just to use round numbers, I think it could go up quite a bit. And I actually have a little bit of a target, because we did have a bit of a gap in the area. Well, it was around 100 to 110 on one of my graphs. The main thing here is you can see even on the 5-year graph, can you see if we get above purple, which comes in around 84 bucks, and recently it went up to 84.50 and backed off. If we can get above that level, we've got backwardation. I'm going to give you some little, funky talk here, but it's not that hard to understand. The front month of the crude oil is trading higher than the back month, meaning the immediate delivery month is higher than the deferred delivery. That tells you there is a tight supply. OPEC Plus is committed to cutting, and you've got the demand season here, and you also have weather. There's supposed to be like 22 named storms. Only one of them has to hit the refineries to cause a lot of problems. And of course, you also have a war where people can hit certain things as well. So there's a lot of reasons why it could take off. And that's why I turn to what would take off if oil took off. And to me, I'm going to the Buffett stock. The guy owns a lot of this stuff, and he's done a lot of homework on it, apparently. So if he feels comfortable with this thing longer term, I don't feel so bad either. So again, very similar. This blue line is telling me it's an uptrend. It's in a congestion area of 60. And if it gets above 70, I think it could fly. And so we'll show you what I thought was a decent idea. You can also slap an I'm a very humble person. So I like to put insurance on everything I can if it's reasonable. So if I'm going to take a shot that this thing's going to go through the roof by the end of the year, why wouldn't I take a little bit of an out of the money put for cheap, just in case I'm dead wrong and it ends up going to 40? Then at least either way, I have a hit going. So, even though I'm a believer this thing could really take off, I still would put an insurance put in there, because generally speaking, when you're wrong on things, you're dead wrong. You're not a little wrong. So the put would take you from being dead wrong to actually making money. And in my career, believe me, that insurance call or put, sometimes it's been the big winner. So even though I'm saying there's a big potential to the upside on Oxy, I still would be putting some type of insurance in there that doesn't cost much. The second one we talked about was the IBB. Now, you guys got to know that the baby boomers, the tail end of the baby boomers, are now in their 60s, and they got a lot of money, which means they probably want to have no pain, live longer, and that has to do sometimes with people, some medicine. So these guys here, to me, are going to be coming up with the drugs that the baby boomers and those thereafter are going to be taking. So I thought, and this is obviously already taking off, that a call option here going to the end of the year, there's all this white area, and I think there's a possibility of a big acceleration to the upside. This Ozempic and all this other stuff is not the end of the story. It's the beginning of a developing story. And all these biotech companies are in the lab trying to come up with the next deal, right? So I think this looks very good as well. And it looks to me like it's already begun. The last one we talked about, and again, it's diversification. The first thing is energy. Here we've got pharma and medical. And the last one is going to be on the industrial metals. The XME is a one-stop shop. What do I mean by that? You want some Newmont Mining gold? They got it. You want some Freeport-McMoRan copper? They got it. You want to get some steel with Nucor? They got it. So it's a one-stop shop. Now, if I go to the 20-year graph on this baby, I see something that could really take off. First of all, it's been nothing but a moneymaker for the last 3 years, right? And you don't buy on strength. You buy it on the pullback. You sell your puts down here. So when it pulls back here, you sell your puts. You pull back here, you sell your puts. Or you buy your calls. Now, right now, it looks to me like it is possibly going to have a very good second half of the year. If that's true, then obviously call options here could make quite a bit of money if gold, silver, copper, steel all make moves. The beautiful thing about some of these metals like copper, they don't make any new mines. So there's not an unlimited quantity out there. And you got China biting on the apple, you got South America, you got Latin America, you got Europe, and you got the US and Canada, Australia, all biting on the same apple. And so if the demand, like China obviously is out of favor, if they turn themselves around again, there's another demand factor that could come in. So some people think in the second half of this year that could happen. Again, that's all good stuff for this thing. So again, do I think it could go through the roof? Absolutely. Would I put some kind of an insurance in there that's cheap? Sure. Because you know what? If everything blows up because we go into a recession that nobody plans on, or they leave these interest rates higher for longer and it causes some real problems, those emergency puts that you put on for small money, they could be not only saving your butt, but it also could be giving you a heck of a lot of profits. Because again, when all this stuff that looks like it's going up happens to turn for whatever reason, be it stock or any of these things, that out of the money put that you just bought as insurance can be the saving grace. But do I think that energy looks like it has a future? Yes. Do I think that biotech has a future? Yes. And do I think that these industrial and precious metals have a future? Yes. How do you play them? We just showed you 3 ways. Daniel's now going to get into the specifics, and then I'll come back in and if there's anything else to add.
Perfect. Thanks, Jim. Great combination of technicals and fundamentals to make these long-term predictions. I think this is really what it takes for that. So I'm going to take over the screen one more time, and then if I can manage to do it, give me just 1 second. And there we go. Okay. All right, guys. So let's be very concrete once again for these long-term directional plays. So what you can expect from our brand new options alert service is exactly what you see here. We're going to tell you exactly which symbol we are considering. What is the strategy at play in this case? All 3 ones outright calls. What is the expiration we have in mind? The strike price and what it would cost you today. So they're all, as you can see here, relatively cheap. And the idea is if this thing breaks out and the directional play works out as predicted, you might be in for a home run move. And this is the going to be the idea behind these longer term options alert. As Jim said, sometimes a little bit of insurance to buy the puts on the out of the money, just in case you are completely dead wrong. As Jim mentioned, if you're wrong, oftentimes you're completely wrong. This can save you as well. And Jim, anything to add about this this breakdown here?
Yeah, I just think we have one misprint there because I was looking at the 150 calls, and I think they were about $500 for each one on biotech.
Okay, so I will fix this. Okay, perfect. Yeah. Thanks for this.
It's still a $500 limited risk with unlimited potential all the way till December 20th in a sector that could obviously go quite a bit nuts on the upside.
Yeah, exactly. And that's the beauty about options, because your risk is so well controlled with the premium, and that's all you can lose.
I was going to add just one quick thing before we end this area. Can I share my screen one last time?
Sure. Yeah, go ahead.
Yeah, because some people might be interested in this, and it's on my radar, so I'm trying to, share it with people here and be a little generous with the information. Uh, we had a very big drop in Bitcoin. And that is attributed to a number of things, including the Mt. Gox settlement, where all these people got their Bitcoins back. That used to be $25,000 in 2014, and now it's 2.5 million. So there's been significant people selling into that, about 9 billion total, which has caused the price of Bitcoin, and that would be Grayscale as well, to come down quite a bit. Now, after that selling is done, it is gone. And there are some people like Tom Lee of Fundstrat, who's really looking for Bitcoin to have a fantastic second half. And so in future updates, I'm going to be looking at this because you can see that it came down to my blue line at, well, look at the blue line, 48.37. What was the low? 48.80. So I've started to take a nibble on this stuff, and I'll ditch it if it breaks under 48. But the bottom line is we could be looking at the low for July. If that's the case, and this Tom Lee is correct, because he is even saying that Bitcoin could double by the end of the year, then there's going to be significant opportunity on the upside on Grayscale, in my opinion. And certainly this would be something. Now, these guys don't have options, but I did want to just be generous with information that people who like to look at Bitcoin, this is a neighborhood where it better hold. If it holds, it looks obviously like it could get right back on the bicycle. What do you call it? And the RSI went right down to 50. So the RSI is holding the positive number of 50. It's holding the blue line. And look, if it doesn't hold 50, you're talking about a pretty big air pocket. So a lot of you guys are interested in Bitcoin. We don't buy it up at 65. We wait for a reversion to the mean. Did the reversion to the mean happen? Yes. Has it hit the mean? It looks like it hit the mean. So 48 is a pretty good number on Grayscale. So far, it's at 51. So you've already got $3 bounce. But again, we'll have to see if this holds the 50 number and if it holds the 48 number. And if it does, and Tom Lee's half right, there could be a good opportunity in Bitcoin in the second half. That's all I wanted to add.
Awesome. Thanks, Jim. Actually, this is a great segue to what I would like to talk about next. We have launched last week a brand new service. We call it the Options Alert Service. And what it will give you really is a triple play of option strategies. I can see just have a small typo in here. Just bear with me until I fix this. There we go. All right. So what you can expect from these alerts is exactly of what we just talked about in this webinar. It's going to be a mix, and I apologize real quick, it has to be just proper, there we go. A mix of short-term strangles, income generation put writing, also more from a short-term perspective, and longer-term directional plays, straight from the desk of the option professor. In addition, and Jim, thank you so much for talking about Bitcoin, you will also get his extra market commentary, which doesn't always have to be option related. It's commentary on the market, his outlooks, and what he considers as important or interesting. And then you can take it away and trade it or take advantage of this information. All right. You can expect these alerts to go out every weekend, and they will go straight to your inbox. So you always know when to expect them, so you can plan for the week ahead when the market opens on Monday again. So if you're interested in this service straight from the option professor, all you need to do is to go to tradingindicators.com/alerts. And Nicholas, please put this link into the chat box if you don't mind. So tradingindicators.com/alerts. And as a special offer, because we're just starting out the
Daniel,
service.
your screen isn't sharing just in case you meant to be.
Oh, Jesus. Okay, sorry guys. Again. Okay. Sorry. What about now? Is it sharing now?
No, it's not loading.
It's not loading. Oh.
I see the options triple play alerts on my screen.
Okay, that's fine. I believe that the screen is potentially showing, Nicholas. Maybe it was just yeah. Okay. So Jim, if you can see it, let me just double check one thing real quick, guys. Hang on. One thing, just gonna double check something. Yeah, it should be good. All right. So, because if you cannot see the screen, please put it into the Q&A, but you should be able to see the slide about the option triple play alerts. And all you need to do to take advantage of this is to go to tradingindicators.com/alert. And this link is also in the chat box of your Zoom window. And you have something very special in store. We have, because we're just launching this and we're just starting the service and we're super excited about this, a special offer for you where you will get the first month at a 50% discount. So instead of paying $197, which is the regular price for this alert service, you will only pay $97 a month. On top of this, you will also get 3 bonus offers. First off, you will get access to the recordings for Options Masterclass. This is 6 hours of options education led by the option professor. We recorded this masterclass about 3 weeks ago, so it's really up to date. 6 hours where all these strategies, strangles, put writing, outright calls, outright puts are explained in detail and much more. So 6 hours of education. You will also be invited to our members-only trading sessions and our Discord channel. Normally a $997 value a year, but you will get this access with your subscription to our alert service. On top of this, and this is of course optional, you will also receive a coupon code for a 50% discount on our monthly subscription service for our Liquidity View dashboard. The charts that I had shown you where I analyzed where are support and resistance levels for these stocks that we're discussing. What is the volatility? When is the next earning date coming up? All these things you can see directly in our Liquidity View dashboard. So I believe this is a great value. You get to try it all for only $97 for the first month. So try it out for low money. If you like it, I believe you will stay on. Then the regular price of $197 per month will kick in. And all you need to do is to go to tradingindicators.com/alerts. So please look at this offer page. There are lots of more information on this page once you go here to allow you to make up your mind. And one more thing I'd like to mention. Yes, Nicholas, go ahead.
I was just going to ask, while we're on the point, how often are the alerts emailed? Keith wanted to know.
Yes, Keith, they are emailed out every weekend. So the way it's going to work out is that Jim, the option professor, because these are coming straight from his desk, is going to do the research for you every weekend and then post it to everybody's inbox once a week with the option trades for the next week and for the future. All right.
Can I add one thing too?
Go for it.
Yeah, with regards to the season called earnings season, which we're in right now, I've got obviously every week there's companies that are going to announce, right? And so what I'm trying to do here, and I'm doing, is be looking for stocks that are announcing, having options that are open during the week that they announce their earnings and the week after. So the next group coming up would be the earnings of the week of July 22 to July 26. And they include some pretty interesting companies like Viking Therapeutics, Bristol Myers Squibb as AstraZeneca, also Freeport-McMoRan and the Newmont Mining. Also big companies like Chipotle, Microsoft, and Google. And then, of course, some more energy in ExxonMobil and Valero. So those would be some of the next companies that I'm trying to see if there's an opportunity there. But the idea during earnings season is to try to give you something to look at that is going to be, shall we say, an expiration date that includes the week they announce and the week after, so that obviously if the volatility hits the week of, we'd already be in. And if it happens the week after, we could benefit from that as well. So I just wanted to say that that is some of the things that I'll be doing throughout earnings season, which I think could be very interesting. As you saw today with Delta, you missed the number and you could lose some value pretty fast.
Yeah, and I believe for our members who signed up last week, Delta was one of the alerts that we put out. And if you took that trade, guys, you probably have on the positive right now for this particular one. All right. One more thing I'd like to mention, then we're going to look at Q&A extensively, is if you are interested in what Jim has to say, and if you perhaps have some very specific questions to him, you can meet Jim through his private mentoring program and learn, as I may say it straight from the source. This is an opportunity to pick his brain, ask him any question, and of course, learn from one of the best in the industry who has truly seen it all. And if you want to take advantage of this, all you need to do is to go to tradingindicators.com/meet. And this link, Nicholas, please put it into the chat as well. So tradingindicators.com/meet. We can see what it will take to meet Jim personally, to ask many questions and be mentored by Jim. All right, guys. So now, with this out of the way, it's time for question. I'm going to start off a question which came in. I think this one may be a bit out there, but I'm going to ask Jim anyways. So, Jim, Frank wants to know, and I believe this is Frank from Amsterdam. I've seen him a few times in our webinars. Do you combine sometimes being short, put writing with being an outright call? Do you combine these two strategies at some point? So you looked at put writing today.
Yeah. Yeah. Good question. Great question. And that's 100% what you like to do if you are at a turning point. So like on McDonald's and Home Depot are good classic examples. When I was looking at selling the puts on McDonald's, we were down at about $243. So selling the 230 puts and taking the premium and buying the 250 calls with the premium, you're $4 in the money already on those 250 calls. Same thing with Home Depot. And then all you're doing is, since you're spending the cash flow, when and if you get put the stock at 230, you don't discount it for the premium because you spent the money. So your break even is in 227, let's call it. It's more 230. But now you've got a position with unlimited potential at 250 that somebody gave you the money down there to pay for. So obviously, if it stays above 230, but it never goes up, it's a wash because Peter paid Paul. Same thing with Home Depot, which is another good call for selling the puts. And again, if you sell puts when the things are way down against support, then it would make some sense to take the premium and buy the call. Similar to the Home Depot here, where when we went down to the support zone down there at around 332, and I'm selling the 320 put, you could have taken the put and bought a 340, 345 call. Let's say you bought a 345 when it was down at 330 with the premium. Those calls are now $7 in the money. That's $700, and you don't have anything out of your pocket from the standpoint of you took your cash flow and you spent it on a call. So clearly you want to entertain that idea. And again, the only thing you sacrifice is a little bit different break even, which is really peanuts, because rather than buying the stock, say at 327, you're buying it at 330. But more importantly, you've got the call going that is in the money now, and Lord knows, it could keep going. I mean, Home Depot is up almost $8 a share here. I'm not the only guy who's saying that there's value down here after the big correction.
Perfect. And guys, if this sounded a bit complicated, don't worry. If you sign up, you will get our options masterclass, where we spend quite a bit of time explaining exactly how you can combine different strategies and rollover trades and so forth for a bit more advanced trading. All right.
The combination of the options masterclass and the options alert is a really great deal.
Yeah. Doug wants to know, for the longer term directional plays, you talked about an insurance put option that you may also purchase if the outlook is bullish and the primary one would be a call. Would you put also this put insurance play into the alert? That's the question.
I can do that. Yeah, I can do that. And like I say, that's right. Yeah, in fact, that's a good idea. And thanks for that question.
Perfect. All right, Keith has an organizational question. Hey, Keith, he wants to know, where can you find the recording of this webinar? Very easy, guys. It's going to be hosted on our YouTube channel. So go to tradingindicators.com. In the top right corner, you see a little YouTube icon. and this brings us to our YouTube channel, we are going to upload the recording of this webinar to our YouTube channel. You will also receive an announcement by email that the recording has been posted. All right, and then one question that came in from Doug. On the alerts, do you provide limit order entries and exit targets? So maybe I'll take. Yeah, go ahead, Jim.
I was going to say, no, I'm giving a price when I saw the strangle, and then if the price has moved, you have your own decision to make, and that would probably entail don't do the trade, or if you still believed in the trade, you could adjust the strike prices. For instance, on the selling of the put of McDonald's, right? And obviously the price has now jumped up. So the premium, the premium that we were talking about obviously is not the same price any longer. So what somebody could do is, if they still believe McDonald's is not going down or they're willing to buy it at a lower price, they could rather go from the 230 put, they could move it up to the 240 put because the stock's about $10 higher, and then get a similar premium at that point, and then basically be agreeing to buy the stock at 240. Because if it's on its way to 260 or 270, 240 is still a pretty good deal on where you're agreeing to buy it. So you could adjust the prices based on the market moving, or again you could just say that the trade does not have the same risk reward, and adjusting the strike is not something you'd like. So that's a decision you can make. And as far as exiting the positions, that's a very personal thing as well. So the individual subscriber will decide, if an option doubles, I'll get out. If it does a certain thing, I will cut and run. If I want to do it, there's many exit strategies out there. And so there's many different people who have different objectives. So the exit will be basically decided by the subscriber.
Perfect. And Doug wants to know, can he ask questions about options in the Discord channel? Yeah, you could do this, Doug. You can also just send us an email directly, which comes straight to my inbox, and I may cover this topic in our weekly member session, which takes place every Tuesday, as you know, at 12 p.m. And of course, as part of the Options Alert service, you will be privy to our weekly members session, so we can cover these questions there as well. And of course, for very specific questions or mentoring, I believe the best way would be to meet Jim, to book a meeting with him through tradingindicators.com/meet, and then pick his brain about a particular strategy or trade that you have in mind, or a symbol.
Yeah, well, real quick on the mentoring session, I've been doing the mentoring session for a long time, and basically I send out the charts that I use, and then I walk you through different option strategies. So you can see the chart, you can see what strike prices we'd be talking about, what the risk and return would be, and how I come up with the ideas of when things might be moving or not. And so I walk you through while I'm on the phone with you, and we're both looking at the same charts. Exactly, and we can look at obviously some things that you're doing, and you could get an opinion from somebody that might, or some technical information that might be helpful in your trading as well. But I've been doing the mentoring for a long time, and everyone really likes it because by the time we're done, they are very much enlightened, and they very much, are much more confident that they know a little bit more about what they're doing.
Thanks, Jim. Awesome. All right, let me see if there are some other questions. So Doug has another one. Yeah, that's a very specific question. I mean, so Doug says he is not allowed to short sell puts due to account restrictions from his broker. Is there any alternative strategy that this can be converted to if you want to do something similar?
Yeah, there are some companies that I'm very much aware of that don't let any shorting of options, even if it's a spread. But the only thing, and of course the reason is that obviously if you get put stock, you have to have the money to buy the stock. And if you start selling puts on something like AMD at 230 and it goes down to 130, you're going to have a substantial loss on the stock. So there's a reason why they don't let everybody do this stuff, because if you do it at the wrong time, it's going to cost money. You get to hold the stock as long as you'd like, but you have to have the money at least 50% if you're a margin trader. And so the only alternative to that would be doing a spread. And sometimes that works out fine, and sometimes it doesn't, as far as, the difference between the two strikes and the bid offer on the two options. So that is the alternative if they let you do credit spreads. But there are some firms that don't let you do any option writing except covered calls. And again, from the standpoint of risk, they don't want the customers taking the risk of the unlimited risk if they're uncovered calls, and they don't want the risk of selling puts on stocks that have gone through the roof, and then all of a sudden, I mean, even Meta went from like 300 down to 100. So all these companies are susceptible to negative moves. So the credit spread would be the way to go if you can do it.
Got it. Thanks, Jim. And one more question from Werner. He wants to know a bit more about the options masterclass and the content that we covered there. So actually, that's a good question. So we have structured the masterclass so that anyone, even if you don't have any knowledge about options, you can follow the topics, because we're starting off in session 1 of this masterclass. There are 3 sessions in total, each is 2 hours long. Session 1 is about covering the basics of options. So understanding what options are all about. What does it mean to purchase an options contract, a call contract, a put contract? What does it mean to sell an options contract? What are the obligations, and so forth? So this is covered in part 1. Then part 2 are about specific option strategies: buying outright calls, strangles, straddles, put writing, credit spreads, debit spreads, and so forth. And then in section lesson 3 of the options masterclass, we're talking about exits. How can you manage an options trade? When should we get out? When should we roll an options trade? Meaning, when should we perhaps extend it to a later expiration date, or perhaps change the strike price? All these things are covered in the last lesson, also 2 hours long, of the options masterclass. So I hope this answers this. And VK wants to know, is there a historical record of the alert service? Well, this alert service, we're just starting it out basically today. There was a bit of a preview last week to a select group, but we're starting it off today. So from this point of view, no. But Jim, I believe you personally, these are trades that Jim, the option professor, is putting on personally, or has put on personally. And Jim, maybe you can expand a little bit on your track record as an options trader.
Well, I mean, we're not going to have a track record like you say. We just started, but also, that past performance is not indicative of future results. It's not just a slogan. So you really want to focus on whatever idea you're looking at, and then of course you want to look at your charts and your information and really concur with what you're hearing and seeing. I've had some very good volatility catches here, because again, the reason I'm trying to do these strategies around the earnings is when there is a news event or an event, that's sometimes when you get a big jump in the volatility. So when we had that worldwide developing conference over at Apple, the week prior to that, I thought that would cause volatility. So I did a strangle of 200 and 190, 200 call and 190 put. And of course, it got people going on a renewal of all the iPhones and the iPads. And so basically the stock went up to 220 in a week. So on that kind of a situation, that's what we're kind of looking for. We're looking for something where we put in, 200, 200, 300 bucks. And if the volatility hits, they can go up to quite a bit more. And then if they don't work out, the premiums we put in are pretty finite. So obviously the math works pretty good if you can find big winners, and then your losers are fairly small. So that's basically the concept. We're looking for inexpensive options on the level 1 that is going to really move for us. We've got a reasonable reason why they could move, and then basically diversify a bit so you don't have to be right on every one. But again, I've had some very good opportunities here where the gains are very large, and then sometimes the markets go dead in the water. And when they go dead in the water, they're not volatile. You're going to lose those premiums. So that's why risk management, money management, diversification, that's really what keeps you to be a sustainable, educated trader. And that's ultimately what we're trying to do here, is find sustainable strategies and educate you so that obviously we can do this for a very long period of time, as opposed to just saying, I'll put all on one idea, and if it doesn't work, I'm gone. That's silly. So we're trying to do it as an intelligent person, meaning sustainable strategies and risk management, then into knowledgeable, educated people. And I think that's our basic goals, and that's what we're trying to do.
Great. Yeah, perfect. Thanks, Jim, for clarifying this. All right, guys. So if you have any further question, now is the time to ask, because we are nearing the end of this webinar. So please consider looking into our brand new options alert service straight from the desk of the option professor. Tradingindicators.com/alerts is the link for that. And if you want to meet Jim in person, or personally, I should say, you can do that too. Go to tradingindicators.com/meet for personal mentoring. And guys, if there was a question which we may have overlooked, or perhaps we didn't see it, or perhaps you couldn't ask because you had to drop off, no problem whatsoever. Simply go to our homepage, tradingindicators.com. In the top right corner, there's a contact form field. Go there, put in your question, and it will go straight to my inbox. And if needed, I will forward this question also to Jim for some further insights. All right, guys, with this out of the way, thank you so much for joining us today. Doug says, thank you so much for this presentation and your time. Yeah, you're welcome, Doug. Thank you guys for taking time out of your day primarily to listen to us talk. I hope you found it useful. And one more question came in. Solomon wants to know, are these 6 hours class online? You will get the 6-hour class on Vimeo if you sign up for our for the first month of our option service, Solomon. So they're not publicly online, but you will get access to these with the subscription of the first month of our brand new option service. All right. So I don't see any questions anymore. So this leaves me to say thank you so much, Jim, for your contributions. It was awesome. Thanks for your insights.
Thanks, Daniel.
Yeah, thank you guys for joining us today, and hopefully see you guys soon when it is again time for another webinar at tradingindicators.com. Thanks, guys. Have a nice trading week. Bye-bye.